Ladies and gentlemen, good day and welcome to Gopal Snacks Limited Q3 FY26 earnings conference call hosted by Emkay Global Financial Services Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Nitin Gupta from Emkay Global Financial Services. Thank you and over to you, sir.
Yeah, thank you. Good afternoon, everyone. I would like to welcome the management and thank them for this opportunity. We have with us today Naveen Gupta, Chief Business Officer, and Rigan Dathata, Chief Financial Officer. I shall now hand over the call to the management for the opening remarks. Over to you, sir.
Thank you, Nitin. Good afternoon and thank you for joining us for the earnings call. We hope you all got a chance to go through our investor presentation uploaded on the stock exchange. We will share our key operating and financial highlights for the quarter and 9 months ended December 31st, 2025. As we reflect on our Q3 FY2026, it is evident that Gopal Snacks has maintained steady progress, demonstrating strong operational resilience and the ability to scale production despite challenges faced after the fire incident. Our revenue for Q3 FY26 was at INR 400.8 crores, a 6.7% sequential increase from Q2 FY26. This growth was driven by strong performance across our core product segments, including the snack pellets and gatia categories, which grew 20.8% and 10.6% on QQ respectively. The growth highlights the continued strong demand for our products and the operational efficiencies we have achieved. A key focus for us during this quarter was the ramp-up of our Modasa facility. This facility, with an added installed capacity of 63,500 metric tons, is now an integral part of our manufacturing base. It will play a vital role in meeting the growing demand for gatia and namkeen products across our target regions. Additionally, we continue to strengthen our supply chain by working with third-party manufacturers, ensuring that we can meet market demand without disruptions. Our efforts to expand our regional footprint have been fruitful with the support of 93 micro-distributors under the SSD model. This initiative has deepened our presence in untapped regions, contributing to 28.7% YoY growth in other states. The success of this strategy is a testament of our commitment to building a strong distribution network and improving market accessibility. In terms of marketing, we successfully secured a significant partnership as the official snack partner for the Filmfare Awards 2025. This association has provided us with an exceptional opportunity to enhance our brand visibility and engage with a broader consumer base across key media platforms. Additionally, our marketing initiative during the festive season, including the Navratri campaign, further increased our consumer reach and brand recognition, and also we launched our gatia digital and TV ad campaign 3 days back. We continue to make progress in improving our distribution management system, which provides real-time insights to our distributors. This system plays a crucial role in improving inventory management, reducing lead times, and enhancing supply chain efficiencies, all of which are key to maintaining our competitive edge. Looking ahead, our focus remains on expanding our production capacity, enhancing our market penetration, and investing in strategic growth initiatives. With the continued operationalization of the Modasa plant, along with our investment in technology and infrastructure, we are confident in our ability to sustain growth. As we move into the final quarter of FY26, Gopal Snacks is well positioned for sustained long-term growth, and we remain committed to creating value for all the stakeholders. I would now like to invite our Chief Financial Officer, Mr. Rigan Dathata, to share his perspective on the financial performance during the quarter.
Thank you, Naveen bhai. So good afternoon, everyone. Let me now take you through the key financial highlights for the quarter and 9 months ended 31st December 2025. Starting with the quarterly performance, during Q3 FY26, we achieved the revenue from operation of rupees 400.8 crores, registering 6.7% sequential growth, supported by improving demand trends, stronger traction in snack pellets and gatia, and continued distribution expansion across newer geographies. Gross profit for the quarter was at 110.6 crores, translating to gross margin of 27.6% compared to 26.4% in the previous quarter. Operational performance during the period benefited from improving manufacturing stability, supply chain normalization following the commissioning of Modasa facility. With the commencement of commercial production in Modasa Namkeen plant, we were able to address key supply challenges that had arisen after the fire incident at Rajkot facility. The consolidation of multiple product categories at a single location is expected to improve order servicing timelines, enhance dealer convenience, which will aid to lowering of our trade discounts and ultimately will benefit the margin. EBITDA for the quarter was at rupees 30.4 crores, reflecting an EBITDA margin of 7.6%. Sequential margin expansion was aided by operating leverage and prudent control over discretionary spends. Our profit before tax increased sequentially 41.5% to 19 crore rupees, driven by stronger revenue and operational performance. Profit after tax for the quarter stood at 15.5 crores, resulting into PAT margin of 3.9% for the quarter. This includes exceptional income of 10 lakh rupees coming from the scrap sale arising out of the fire-affected facility. Moving to the 9 months performance. For 9 months, FY26 revenue from operations stood at 1098.6 crores, while EBITDA is at 69.7 crores, reflecting the margin of 6.3%. Profit before tax, before exceptional items, stood at 37.7 crores, while profit after tax was 43.7 crores with a margin of 4%. As we move into the final quarter of FY26, our priority remains focused on expanding market presence, improving operational efficiency, and continue to drive for innovation in our product offerings. With our strengthened manufacturing network, including the newly operational Modasa facility and a disciplined approach to capital allocation, we are well positioned to sustain our growth. We are confident that Gopal Snacks, through its strategic initiative backed by strong financial foundation, will continue to deliver long-term value for all its stakeholders. Thank you. Over to you, Nitin.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nitin Gupta from MK Global Financial Services. Please go ahead, sir.
Yeah, thank you. So my first question is around post-commissioning of Modasa facility. So I basically wanted to understand how has been the growth improvement. We have seen 3 quarters of decline, and this is the first quarter we have seen 2% revenue growth. So how materially a shift is happening now, and how management is thinking that the growth can improve on a monthly basis from current levels? That's the first question.
So Nitin bhai, as we had finally declared that from 1st of December we will start getting our complete range from Modasa facility. So we started getting complete range from our Modasa facility from 1st of December. So its reflection also came in our December number as well. So now overall supply chain from Gujarat perspective are stable, as well few connecting states like Rajasthan is completely getting catered from Modasa only. And then there are parts of Western Madhya Pradesh and Mumbai, and some parts of Western Maharashtra also getting catered from Modasa facility only. So things are stable now. So overall revenue loss owing to the supply chain disruption in Gujarat was to the tune of 8-10%, and even in the surrounding states, Rajasthan was impacted the highest. So with the improved supply chain, we are confident that our run rate will certainly improve.
Yeah, that's really encouraging. So, we are actually from December, seeing the growth, the supply improvement, plus additionally the GST sort of support also from the government in terms of the rate reduction. So, qualitatively, would you be able to highlight how material is a shift in the numbers from November to December? Definitely, December will be ramping up. It will not be a true reflection, but some qualitative sense would be really helpful here.
Our December numbers were 7% more than November.
Okay, sir. This is good. And second, with respect to gross margin expansion of 120 bits to 27.6, this is more of a sequential QOQ. So could you help us understand the factors which have aided growth, margin expansion? One point I can take from the commentary is that we have taken back some of the trade promotion, but if you can help us understand this better, that would be really helpful.
Yes, Nitin. So post our supply chain issues, since I started getting resolved, so partially from the mid of November, we started lowering our trade discount schemes, and on account of that, the benefit which flowed on our gross profit was around 1%, and also marginally due to the low margin products or the loss making products, also we are trying to cut out from our product basket. So that is also aiding to our gross profit margin. Raw material prices were by and large stable. So over there, 0.3% benefit is there. And again, post GST regime, we have also reduced the dealer margin, which has also benefited 0.5%.
Sure, this is helpful. My last question pertains to this new other snacking segment. We have basically split the other segment into two. So now I can see other snacking segment is now 4% of revenue, and it is seeing in a way this percentage was around 1.7% last year. So how we are positioned here? We have multiple products: masala noodles, bakery, flour, oil soap, jaggery. So is this more of an adjacent business, or you think that some of the categories can become bigger for us? I have seen there is an ad, wheat flour also we are getting into. So I just wanted to know your thoughts around multiple new categories we are trying out in other snacking.
So, Nitin bhai, in our multiple commentaries, we have expressed our intent to gradually reduce our dependency on imported oil. So, as Regan bhai stated, we are doing two things simultaneously. One is cutting tail of those products or SKUs which are low in margin contribution as well as revenue, and simultaneously adding certain products which has got better margins and which are scalable in nature. So to name couple of products, three products. We introduced somewhere in July popcorn. So popcorn run rate is right now 55 lakhs per month. We added wafer biscuit. So it's a comparatively high margin product, and our run rate is 65 to 70 lakhs per month. And we added another bakery product which is in 5 rupees price point, which is Kaju biscuit. So it's a Kaju shaped, biscuit. So it has also got good margins and which has started contributing to the tune of 35-40 lakhs per month. So this is helping us in two ways. One is, overall product basket. We are trying to reduce contribution of imported oil, and second is we are adding high margin, high scalability potential product to our product basket.
Sure, this is helpful. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Risha Mehta from Green Edge Wealth. Please go ahead.
Yeah, thank you and good afternoon. So congratulations on the commercialization of the Modasa facility. So now with this, like the Q-on-Q numbers have been better, like you called out, December is higher versus November by 7%. Do we see a similar kind of growth rate which is also happening as we speak in January, because we are almost at the end of January?
Yes, numbers are in line with our December numbers. Historically, out of last 5 years, Q4 has been lower than Q3. In 4 years, out of 5 years, 4 years, Q4 has been lower than Q3. But we are confident of reversing this trend this year. January numbers are, in line with December numbers, which historically has not been the case.
Understood. And now, like you said, so the supply chain problem gets solved, right? Like we are able to supply a full basket to our distributors, and hence that problem has completely gone away, right? With at least 90% solved, right, with the Modasa facility?
We can say as on date, more than 95%. We just did an exercise yesterday, so our fill rates as of now are, with stipulated tax is 93%.
Right. And so does that mean that the wafers degrowth which was happening, because it was more like a, push product for us, right, providing it as a part of the overall basket. So that degrowth should kind of start reversing?
Yes, that degrowth will start reversing. There are two reasons of degrowth in wafers, Resha ji. One is we took an intentional price hike in wafer. So differential with the market leader versus our pricing to the retailer was to the tune of 20%. So we brought down the difference to the tune of 6-7%. So probably we had not matured in that category to that extent that that steep hike was not taken generously by the retailer fraternity. And secondly, as a company, what we were doing earlier, suppose we were giving a target of distributor, the monthly target was 50 lakhs. So we were doing a bundle activity with the wafer category to the distributor that he has to sell minimum say 7 lakhs or 6 lakhs of wafers to get the monthly incentive. But later on, owing to our supply chain issues, we thought of, not putting the pressure on distributor fraternity for the push product. Rather, we were giving them, a lot of comfort in selling the pull products only. Now, since our supply chain issues are resolved, so we will restart that activity. In fact, from 1st February, I am going to restart that activity.
Okay, and you just called out that, we had taken price hikes in wafers. I would imagine, would we have also taken price hikes in, other products like Gathia? Because I see the volume value gap is, there's quite a gap between the volume growth and the value growth, even in Gathias. So have we taken price hikes there as well, which has also helped in improving gross margins?
I tell you, when we compute in number of packets, so it looks like that we sold lesser number of packets. However, when we convert the volume in metric tons, so we have grown by 4%. So typically what happened after GST, on price point products, we passed on that benefit to the consumer by giving extra grammage. So we did not take any price hike or price drop in price point product. However, in larger packs, we took a price cut. Like on MRP basis, earlier the product getting sold was of 50 MRP, now we are selling at 47 MRP. 500 grams we were selling at 89 MRP, now the MRP is revised to 84. So absolute terms we more in metric terms.
And our trade spends used to be at somewhere around 3.5%. So since we've seen some reduction there, which you've mentioned. So now that number is reduced from 3.5 to what levels now?
So in this quarter, we have reduced it by 1.2%.
Okay. Okay. And subsequently, this is expected to, like in Q4 also, would we see further reduction on the trade spends front?
We will take a reduction, on a very gradual pace, Resha ji. In Q4, it will be more or less in line with Q3. However, in Q1, then we reduce it by 0.25%, and then we'll try to maintain that for 6 months. So annualized basis pay, next year we'll reduce it by 0.5%.
And, so now, would you be comfortable in giving some kind of a guidance for the next financial year? I understand that seasonally Q4 is weak. So, what you're giving a sense is that, but we should still be higher than 400 crores or thereabouts in Q4. But in FY27, considering Modasa plant has been commercialized and our supply chain issues are largely resolved, would you like to give any kind of revenue guidance and therefore even a margin guidance, assuming raw material prices remain stable?
So Resha ji, we on YTD basis, we have touched 1100 crores, right? And our Q4 numbers are visible, and Q3 numbers are visible. We are stating that Q4 numbers, we are reversing the trend. So, we'll be somewhere, 1500 crores kind of number we will be closing this year. So next year, we have made a rough sketch of our annual operating plan. So we have taken a delta of 300 to 350 crores for next financial year in our plan.
1800 to 1850 crores. And on the margins, EBITDA margins, assuming raw material prices are stable?
So on the top line front, it would be in the range of 18 to 1900 crores. That is what we are anticipating. And in terms of EBITDA margins, so like in the current quarter, our EBITDA margins are close to 7.6%. So as we would be exiting on the similar rate, so next year we are targeting on an annualized basis EBITDA margin between 8 to 9%. Within next year, exit rate close to double digit.
Wouldn't you say that 8 to 9% annualized margin for next year is very conservative, assuming raw material prices are stable? Or are we, despite Modasa plant being operational for 2 months, we've not seen, those distributors whom we lost, they're not coming back, or maybe we are not seeing, market share gains again. So that's why, we would want to guide for lower margins, or is there some other reason?
So there are a couple of other things. One thing, so post Modasa commissioning, so that we are quite confident. So over there is nothing of an issue. As in our opening commentary, we say we are now aggressively moving into the market in terms of spending more on the advertising, sales promotion schemes. So that is one of the things. So sequentially, probably we would be improving on the trajectory. So probably in, let's say, in first or second quarter, improvement might be little bit less, but next going forward, it should be on a very fast trajectory. So that's the reason we are likely to maintain between this range, and that's the reason we are also seeing that our exit rate would be much higher than the average rate.
Understood. And on the other products, right, I think even the previous participant called that out. While I appreciate that, we want to reduce our dependency on palm oil, but, I think we are also selling beauty soaps and washing bars and ghee. And jaggery, right? So wouldn't you say that, these are completely unrelated products? What would be our right to win? And, very fringe. What are your thoughts here? Why are we getting into these products?
These are, our byproducts only, Resha ji. When we process our products through oil, so a lot of oil gets generated as a byproduct. So this detergent, this oil, soap, and this is byproduct.
Understood. All right. Thank you.
Thank you, Resha ji.
Thank you. The next question is from the line of Asrahuddin Jariwala from Samiksha Capital. Please go ahead.
Thank you for my question. My question is started off with geographical
Azruddin, your line is not clear.
Am I audible now?
Yes, you're audible now. Can you please repeat?
Yeah. So thank you for taking my question. My question is on the side of the geographical volume, which we are seeing quite muted growth in the core market of the company. So I just want to know about how are we taking the measures to stabilize and revive the volume in the core market?
Sorry, I couldn't get your name.
So, Azruddin, sir, there is some static in your end.
Am I audible?
Your voice is not very clear. However, what I could understand that you are asking that what is our strategy to grow in core market, right?
Correct.
So there are two things which we have already started in Gujarat, which is our core market. One is frequency. So we have initiated to increase our number of salesmen, and that is completely facilitated by automation. Number two is when we have started our marketing endeavor like TV campaign, digital and print, etc. So that is going to aid growth to our core market faster than non-core markets. So if I summarize, one is improving on distribution efficiency and another is it has to be backed by marketing endeavor.
The line for the participant has dropped. We will move with the next question from Shreya Chatterjee from Angels Capital. Please go ahead.
Hello. Thank you for taking my question. So I wanted to understand a bit more that the quarter-over-quarter growth in the focus markets is a bit slower than the core market. So what are like our strategies on the focus markets? What would be the future growth rate in the focus markets? And what about adding distributors in both the core and focus markets? If you could give a bit more color to that.
Yeah, Shreya. So one thing is in core markets, we will not add to number of distributors. We have got footprint in 99% of Gujarat at tehsil levels. So we will not add to number of distributors in our core market. Now coming to focus and other markets, we have taken an ambitious aim of adding one net new distributor every working day starting from 1st of January till 31st December. So right now we have 881 distributors on our SAP, and we have taken an ambitious aim that we will add somewhere between 250 to 300 distributors within this calendar year. So coming to how will we perform in focus markets. So there was a reason that why in focus markets our growth rates were not, these were subpar. One was Rajasthan, West Maharashtra and West Madhya Pradesh was, disturbed in terms of supply chain. However, these are streamlined now. So within focus markets and other states, the growth will come from two factors. We have aimed just 15% growth from our existing distribution network and roughly 75 crores of delta will come from addition of new distributors. So there will be a complete ladder which will get built the way we did in 2024 as well. From April, yeah, please.
Yeah, so the guidance of 1800 to 1900 crores, which you just gave now for FY27, is it factoring into this 250 to 300 distributors, that ambitious guidance? Like even, or are you taking into consideration like even if like 80 to 90% of it is achieved, you'll be able to take 1800 to 1900 crores?
We have taken a range of 150 crores to 160 crores delta coming from our Gujarat business. From non-Gujarat business, we have taken an aim of delta of 130 to 150 crores. So out of this 140 crores, 70 crores will come from existing set of distributors and 70-75 crores from new set of distributors. Besides this, there are alternate trade channels. So by alternate trade channels, I mean that we have got business of railway, modern trade, quick commerce and exports. So unfortunately, in the entire year, YTD, we have just done 80 lakhs of export this year, whereas previously we had done 8 crores of export this year. So delta coming from these alternate trade channels will be 25 crores. So that will translate into the overall delta of 350 crores.
So is it then fair to assume that we can see a growth rate of 15% plus in the focus market once everything stabilizes? And also,
Yeah.
what is your capex plan going ahead, given that now you are increasing the grammage in your packet? So what would be the capex plan going ahead?
Answering your first question, Shreya, in the core state, there will be 2 regions for us to grow. One is our stabilized supply chain, which will be backed by automation and distribution plus our marketing endeavors. Coming to capex part, let Mr. Regal answer to this question.
So as far as capex, since we have enough capacities available currently, so we don't require to build any additional capacity to incur additional sales or to improve the grammage.
Got it, sir. Thank you. And so about the namkeen category, do we see the growth coming back once the once we get a full quarter of operational Modasa facility, or is there a degrowth of some sort in the namkeen category? Because there has been a slight degrowth in the namkeen quarter over quarter.
Yeah, so let me deep dive into the numbers, Shreyaji. Typically, when we start our operations in Modasa, so our first priority was to manufacture the single line product items. So all the gathiyas are, single line product items. Whereas when we sell namkeens, so namkeens have got 5 items which have got mixture. So manufacturing mixture is a comparatively complex thing, because then you have to, do mixture of several things. So now, since entire production and supply chains are stabilized, so namkeens will also come into growth trajectory.
Got it, sir. Got it, sir. Thank you.
Thank you. The next question is from the line of Azharuddin Jariwala from Samiksha Capital. Please go ahead.
Yeah, am I audible?
Yeah, Mr. Jariwala, you are audible now.
Okay. So my question is on the side of the geographical volume, as we are seeing quite muted growth in our core market. So how are we taking any measures to revive the volume in core market?
Yeah, Mr. Jariwala, I already stated that if you consider Gujarat as our core market, so strategy is very clear that one, since our supply chain have stabilized, so distributor will have already started getting full range from one place only. So that helps in faster rotation of his business. Second, we have already started automation of our distribution ecosystem, and that we are complementing through adding more number of salesmen to cater majority of outlets twice in a week instead of once in a week. And third factor will be, marketing endeavor. We started our TV campaign as well as digital campaign as well print campaign 3 days back. So that is going to help largely into core markets itself, which is Gujarat.
Okay. And for the next year, as you are assuming the delta of 300 to 350 crores incrementally, so how are you looking at the category-wise, like the gathia and namkeen, or any which are the higher margin products which you are focusing currently? So how are you looking at the category-wise revenue?
See, at company level, if we are aiming to have a growth of 20% plus, so that will come from the respective categories only. So in our frames category, this was first quarter after so many quarters that we are able to bounce back. So frames we will continue to grow by 20%. We are doing certain innovations and renovations in our frames category. In gathia category, it will be aided through TV ad and marketing campaigns. So gathia we will certainly grow by 20%. And in wafer category, since our base have depleted, so we will like to come back to our original run rate. So the overall growth we are aspiring 20% plus, so it will get reflected in across categories.
Thank you. The next question is from the line of Amit Agicha from HG Hava. Please go ahead.
Yeah, good afternoon, sir, and thank you for the opportunity. So, what was the marketing spend in Q3 and 9M for FY26 in crores and in percentage of revenue?
So in Q3, in terms of percentage of revenue, it was close to 2%.
And would it be possible for giving you the 9M figures, 9 months figure? If you have it, it's okay. Otherwise, you can mail it later. And sir, also, how does the management measure the return on investment on the sponsorship which all did in Filmfare and festival sponsorships?
See, Amit bhai, it was first mega event in which we did participation, right? So it was important for us to, before we launch a TV campaign, so it was important for us to get into some sizable platform. So there are agencies, third-party agencies, which gives us measurement in terms of improvement in brand recall value. So if we consider that in terms of revenue, how much, what was the ROI? So that is attributed to various factors. So it's challenging to dissect that how much incremental revenue came from which factor. However, we have already delegated this task to our marketing agency to measure how much improvement it is giving us in terms of brand recall value.
Mm-hmm. And so would it be possible for you to give what percentage of revenue currently comes from e-com, Q-com platforms?
Yeah, sure. So on YTD basis, we have done 15 crores revenue comprising of 4 alternate trade channels. One is railway, another is modern trade, third is quick commerce, and fourth is export. Q3, our railway business was 2.3 crores, modern trade was 1.48 crores, and quick commerce was 1.91 crores. And Q3 exports was 0. And on YTD basis, railway we have done 5.41 crores, modern trade 3.59 crores, quick commerce 5.3 crores, and exports 80 lakhs.
And so do you see this e-commerce as a brand building channel or a material revenue driver over the next 2 to 3 years?
I mean, it's both for us. Next financial year, we will be doing, on annualized basis, we will be doing roughly 15-17 crores from commerce. So that will translate little less than 1% of our top line. So, I mean, it's helpful in definitely in brand building as well. Because
as a last question, please continue.
And we sell product at quick commerce platform, so it's not price point product. It's in-house consumption product. So it helps us in brand building as well.
And the last question, sir. So how does management balance the debt reduction versus growth capex post the fire recovery?
Sorry, come again?
How does management balance the debt reduction versus growth capex post the fire recovery?
So in terms of debt, currently we have only working capital facilities with couple of banks. So we don't have any term loan in our balance sheet currently. And in terms of capexes, post completion of the fire related capex, we don't foresee much of the capexes. Majorly going forward, capexes mainly would be either it would be profit margin improvement or would be some maintenance capex.
Thank you for answering my question, sir. All the best for the future. Thank you.
Thank you.
Thank you.
Thank you. The next question is from the line of Dharmil Shah from Dalmus Capital Management. Please go ahead.
Hi. Thank you for taking my questions. So first question is more on the Q4 commentary, which you mentioned that it would be similar to Q3. In Q3, the Modasa plant was only operational for the December month, and despite it being operational for the entire quarter in Q4, why is it that it would be at similar levels at Q3? I mean, are there any other challenges apart from manufacturing we are facing right now at distribution level or on the ground?
I mean, there are no such challenges, Dharmil Bhai. As I stated that historically Q4 is always weaker versus Q3 to the tune of 4% to 10%. So we will definitely reverse that trend. Either we will do at par or it will be slight better than Q3.
Okay, understood. And the challenge you mentioned that you are increasing the salesmen at ground level. How long would it take to normalize this challenge post-fire, what you had mentioned?
Yeah, that's an ongoing exercise. I started that exercise somewhere in May 25, but then we backed out because of operational challenges and we stopped that exercise in July. So we have restarted that exercise now, and in last couple of months we are able to add 200 more salesmen in Gujarat alone, and now roughly 24% of the beats are getting double coverage. So that procedural change is taking some time, and then there is a behavioral change because how does a retailer react to double service? How a distributor is able to manage the secondary distribution supplies when booking frequency has gone from once in a week to twice in a week. So overall, typically it takes 100 days to stabilize once we start, double service in a particular market. But when I say it's a gradual process, so we have got 324 distributors right now in Gujarat. So already at 85 distributors, we have full beats under, double coverage, and roughly 45-50 distributors are such where partial beats are under double coverage. So when I say gradual, so over a period of time, we will bring 80 to 90% of our dealers and beats under double coverage. So that will take overall, so the whole thing will take 1 year to get stabilized.
Got it. And you initiated the marketing campaigns in November. I mean, Filmfare was one, TV ads, and because most of our portfolio is impulse category tilted, the impact should have been more, right? I mean, what are you seeing the trends from the marketing campaign?
See, the Filmfare was one of the events, and we didn't spend much money to amplify that event. However, our full-blown communication started on 25th of January only, just 3 days back only. So we have yet to assess. And we are sure, since I have my own previous experiences, that when impulse category, buying low price, low involvement category or replaceable category kind of brand, start the marketing campaign, then how does core market react and how non-core market react? So there are a lot of curious distribution inquiry calls from non-core markets. However, actual revenue, absolute revenue growth comes from core market. Because non-core mein to you have to first respond to that distribution inquiry call, and that the ratio of converting from inquiry to actual appointment is just 1.4%. So if we get 100 inquiries, then only 1.4 distributor actually get appointed. Uska revenue आने में तो the core market से ही advertisement का impact revenue terms में ज़्यादा मिलता है और जल्दी मिलता है.
Understood. And for this core market, the marketing campaign would only be through TV ads, or I mean, are we tapping into social media as well?
360 डिग्री है, सोशल मीडिया है, डिजिटल है, रेडियो है, आउट ऑफ होम है, प्रिंट है, टीवी है।
Okay. And what is the budget that we have kept in mind, I mean, to incorporate all of these campaigns?
Q4 के अंदर ये मोटा मोटा 8 करोड़ का हमने बजटिंग किया है इसका।
Got it. Got it. Last question. I mean, if you see the organized player in the snacking segment, each company has got a, hero product, which is successful at pan-India level, not just very state-specific, bhujia or is it wafer for some other company? Do you think Gatia can become a hero product in a long time because it's a very community-specific product so far? But do you think it's possible maybe in next 5 to 10 years? And what would it take to do that?
No, Dharmil bhai. So I'll request you to go through, slide number 9 in our presentation. If you see, Gatia contribution in FY23 from core state was 76.4%. And it is 69.3% as on date. In Uttar Pradesh, my current run rate is, 6 crore rupees. So out of that 6 crore rupees, 72% contribution comes from just 2 SKUs of Gatia. Similarly, Jharkhand run rate is 2.5 crore rupees. So out of that 2.5 crore rupees revenue, 1.75 crore revenue is coming just from Gatia only. So this is what I have been stating in my previous commentaries, that ownership is on us. We are flag bearer of this category. So we have to shoulder this responsibility. This is why a true marketing campaign was badly needed to make the product more visible nationally. So we have just unveiled that campaign. So we will certainly improve a lot in distribution, and marketing campaign will definitely help us in expanding our hero product category.
Got it. That's it from my side. Thank you so much for answering. All the best.
Right.
Thank you. The next question is from the line of Bhumin Shah from Equirus Securities. Please go ahead.
Yeah, good afternoon. I have only one question. Across the category, there is a delta between the revenue growth and the number of packets sold on a YOY basis as well as QOQ basis. So can you explain that if we have taken any price hike or behavioral changes are there and people are moving towards the higher grammage packet or high price point packets?
So, Bhumin bhai, see, there is decline in number of packets. However, in absolute metric terms, the growth is 4% in volume terms. So, consumer has overall eaten in more quantities. So, we have not taken any price hike except in wafer segment. So, we understand that in terms of packets, there has been decline. But with various measures which I just stated in my, on the previous question, we'll recover on that part as well.
Correct. So there is no change in the composition of rupees 510 or larger packs being sold, because if I look at Gatia for QOQ, there is 2% growth in terms of packets sold, whereas there is 10% growth in terms of revenue.
Yeah. So, if we see the slide number 25, so we can see by price point now above 10 MRP contribution is 18%, whereas 5 rupees price point contribution is 63.3%. And if we talk 3 years, like somewhere 22, 23 years, so 5 rupees price point contribution was to the tune of 80% in product basket of Gopal.
Okay, thank you.
Thank you. The next question is from the line of Shirish Pardeshi from Motilal Oswal. Please go ahead.
Hi, Naveen. Regan bhai, good afternoon.
Good afternoon.
Yeah, just on slide 22, just extending the previous question, we have GST event coming up. That's first part. Second, we have ramped up our facility and production. Third, last quarter, we also said that we are building the contract manufacturing. So this question is specifically on the UP and the other markets. I think the growth is picked up, but when I do the maths, you said that the volume growth is 4%, which is still lower. So I'm not able to reconcile because your volume crore package growth is 0.9 for Gatia. I'm talking about only specific for Gatia.
Just give me a moment.
Yeah.
We increase the grammage in price point packs. All 5 rupees price point. We are giving 21, 22 grams. So now we are giving 23, 24 grams. So there is 6.6%. 6.6% volume growth in terms of metric ton in 5 rupees SKU price point in terms of tonnage.
Okay. But you said it was 4%. The volume growth, metric tonnage growth was 4%.
Overall 4%. But in 5 rupees price point, it is 6.6%.
And what could be this number for specifically for Gatia in terms of tonnage growth, volume growth?
I will have to check. Just give me a moment.
Okay. Maybe later on you can share. The second question is UP apparently is a very large market and we also have a very positive view. Can you strip out the growth we are expecting in UP in terms of capacity expansion, in terms of distribution expansion, and in terms of scale-up of our product portfolio?
Right. So let me come to capacity expansion. We already commenced a third-party operations in Kashipur 3 months back. So we are manufacturing just 4 SKUs there series wise, and these 4 SKUs eventually contribute more than 80% of our top line currently in Uttar Pradesh. So we have no dearth of capacity or no supply chain issues as of now in Uttar Pradesh. So distributor earlier was getting stocks in 3 days from Nagpur. Now he is getting stocks either second day or third day maximum. Now coming to distribution expansion part, we have currently 110 distributors in Uttar Pradesh, and the maximum number of distributors which we have aspired to grow is in Uttar Pradesh and the area surrounding to our Nagpur factory. So we are aspiring 180 plus distributors in this whole calendar, by end of this whole calendar year in Uttar Pradesh.
Okay.
As expansion is concerned, we are trying to work on efficient distribution model as well as efficient product baskets. So we do not intend to expand our product basket particularly in Uttar Pradesh market. That will be purely need-based and situation-based. Whatever new distributors we are going to appoint in Uttar Pradesh, we will keep them confined to a very limited number of SKU product baskets, so a regular salesman can cover more than 50 outlets per day instead of selling more number of SKU and just covering 40 outlets in a day.
Okay. And on the Modasa, you said you are 4 categories you started manufacturing or full range is started?
No, not 4 categories, just 4 SKUs, Shirish bhai.
Modasa.
Modasa. I thought Kashipur. Yeah, Modasa. Yeah.
So, Modasa, how many categories you started now manufacturing?
Our 100% categories is getting manufactured in Modasa right now. Everything.
Okay.
Everything except third party. There are 4 third party products like banana wafers we get manufactured from third party. Then there's a Kaju biscuit and wafer biscuit which we get manufactured from third party. So except these items, everything is getting manufactured in Morasa.
So today, Modasa will stabilize maybe about 50-60% capacity utilization in quarter 4 and March, or will be lower? I mean, you are scaling up the operations, so that's why I'm asking this question.
So capacity utilization in the current quarter, it was less. Obviously, in the March quarter, it should improve. So it should be in the range of around 50-55%.
Okay. And this Rajkot will, by what time you will start getting the capacity utilization? Do you have any timelines you have started out?
So Rajkot plant majority should get operationalized by the last week of March or probably by the mid of April. So that should start reflecting in the next year's first quarter.
So all in all, you are very confident that you will match the revenue what you have achieved in FY25 and you will be recouping the margin because of the operational efficiencies. That's what we should look at 26 or will be lower?
So in terms of top line, yes, we should be higher than the last year's full year's number. And in terms of margin, full year, in terms of EBITDA, we should be around 7%.
Okay. All right. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Sohan Samanta from Motilal Oswal. Please go ahead.
Yeah, thank you for the opportunity. So just wanted to check on gross margin because in 9 months we have done 27.5. So how do you expect to close this for this year, gross margin?
Gross margin for the full year, if you are referring?
Yeah, for FY26.
So, full year gross margin, we would be around 27%. So, in the Q4, we are expecting gross margin to be in the similar lines of Q3.
So, just a hypothetical over here, as you mentioned earlier that our EBITDA margin would be in the range of 8 to 9 for FY27. So, assume earlier we used to do 11, 12, I mean 2-3 years ago we used to do on the range of 12%. So, obviously for next 28, it's not possible to go in that level. But if Gopal Snacks wants to go in that level particularly, what are the key factors you should look from 9% to 12%?
So, one thing is, so by 28, when you say 28, obviously we would be aiming to achieve that number. So, when we say next year, when we are saying 9% around, and I say the quarterly our exit rate would be near to double digit. So obviously for the 27-28, then double digit becomes the normalized EBITDA margin. So we should be reaching to that kind of an EBITDA margin by 27-28.
So in that case, what? Factors. Yeah.
You asked a question.
Yeah. So basically, that's what I'm asking. What are the key factors from 9 to 12%?
So key factors 9 to 12% would be one. We would be, as Navinji said in the previous questions, we are improving our product basket mix. We are reducing the categories, or we are cutting down the products wherein the lower margin or the very minimal margin was there. Instead of that, we are introducing the high margin products. Secondly, once we will shift from fully from Gundal to the Rajkot facility, that should improve our operational efficiencies. Thirdly, our freight cost should also improve from the Modasa, which we have said previously should benefit on a yearly basis somewhere around 8 to 10 crores of rupees. That should translate around 0.5 to 0.6% margin. Thirdly, the wherever long-term agreements we have entered, that should also improve our efficiency level because freight cost would reduce over there also. So these are the few parameters, and also we are introducing in terms of process efficiency everywhere the bio coal would be used, so that also should improve our operational efficiency. We are coming with the basin plant at Rajkot, so that should also improve by 0.2-0.3% of our EBITDA margins.
And Sombai, not to forget, then when we start incurring marketing expenses, so that gives us trends to take little more money from consumers' pocket as well as from trade pocket.
Right. And last questions from my side, like if we're to grow 15% over here, how do you look Namkeen as a category? Is it a par with our core market? I mean, if we expect 15% category growth, Namkeen would be at par or would it be much lower or higher? How do you look the Namkeen category?
See, Namkeen, the growth rate across category will be between 15 and 25%. Wafers, we will aspire to do more. However, our total wafer value base is lower, so it may be 30%, in the range of 30%. So Gathia 20%, and then Frams is 20%, wafers 30%. So Namkeens will be between 15 to 20%.
Got it. Okay. Thank you, Naveenji.
Thank you so much.
Thank you. As there are no further questions from the participants, I now hand the conference over to the management for closing comments.
I would like to thank everyone for joining this call. I hope we have been able to respond to all your questions adequately. In case of any further information required, we request you to please get in touch with our investor relations team. Stay safe, stay healthy, and thank you once again for joining this call.
Thank you. On behalf of Emkay Global Financial Services Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you, everyone.